Paul, can you hear me?
I can. Can you hear me?
Awesome. Yeah, you're coming in through great.
Great.
This is great, and thanks so much for making some time. I want to be respectful of your time, and we do have some attendees already in uh, in attendance, but this webinar is being recorded, so anyone who needs to catch up to it can always ask for the recording. So I want to be respectful of your time and go ahead and get into it if that's okay with you.
Yes, of course. Happy to be here.
All right. Well, thanks. How are things down in Miami at the moment?
Things are good. Things are hot, as you might expect. The humidity is here and in full force.
Mm.
So there'll be probably some beach days in my future. But for now, I'm just kind of enjoying the air conditioning here in the office.
Good,
How
good.
about you? How are things for you?
Oh, things are great. I don't know if I had a chance to talk to you, but my we had a baby girl about 2 months ago. She's 2 months old
Yeah.
now. That
Oh my gosh.
that's been exciting and
Yeah.
definitely a new phase and definitely needing, a couple extra hands, but we're fortunate. So all good stuff. And that's the major update. Um, and then I just thought that this would be a good conversation to have. You and I speak on a reasonably regular basis just about markets and allocations and client portfolios. And given all the news and where we are, in the market cycle, where we are in the, political election cycle, where we are in the rate cycle, et cetera. I thought it'd be really cool if we could have one of our topics, one of our normal discussions, and just invite clients to participate in them, by
Yeah.
viewing and doing it on a webinar format. So I put a couple of talking points together. I'm going to ask for your feedback. We'll get through it, and then there will be a little bit of time for Q&A for clients that have specific questions. But like I said, really appreciate you being here and making the time.
Of course. It's my pleasure. Happy to do it.
Okay, so uh, just like any type of webinar that's going to be recorded or presented, I have to make sure that the Geneos disclosure is there. My clients know my business, Directed Wealth Strategies, and they also know that I offer securities and investment advisory services through my broker-dealer relationship, Geneos Wealth Management, and that is who employs you. Before we get into it, we just need to say that this information is provided for general purposes. It's subject to change without notice. It does not represent, warrant, or imply that services, strategies, or methods of analysis offered can or will predict future results, identify market tops or bottoms, or insulate investors from losses. All types of investing and investment strategies involve risk, including the potential loss of principal. Asset allocation and diversification do not ensure a profit or prevent a decline in a declining market. Past performance is not a guarantee of future results. Before acting on information, please consult your financial planner or advisor about your individual circumstances. So good. Now that we got that out of the way, just wanted to go ahead and make some introductions. Like my clients know me, they know my background, they know who Geneos is, Directed Wealth Strategy is. But for those listening, I asked Paul Knipping to join me here. Paul is a CFA for Geneos. Um, Paul, why don't you just give a few words about what a CFA is and what it does in the financial services industry?
Yeah, sure. So the CFA stands for Chartered Financial Analyst, and it's a designation that you can get through the CFA Institute. And it basically goes over equity research, equity valuation, and portfolio management. There's three levels to the designation. They offer each exam once per year. Um, yeah, and it was a very grueling, very challenging process for I think everyone that goes through it, but certainly worth it. And it really helps me do this job that I do now, frankly.
Mm-hmm.
Um,
And I like to lean on Paul because I'm a certified financial planner, and I wouldn't say that the coursework to become a certified financial planner is quite as grueling. We do a lot of tests and exams. on investment analysis, so I can kind of speak the language. I can get through some good stuff. But a certified financial planner's main abilities is to be able to wear many hats and be able to be fluent in a lot of different types of conversations that bring value to clients. But a certified financial planner is not a CFA. And so that's why I do appreciate periodically asking Paul for his insights, which tends to be a little bit more in depth and a little bit more, you know, deep than some of the things that I do. Um, Paul, why don't you just also introduce Axiom? A lot of my clients are on the Axiom platform. Not everybody, though. I've got some clients that are in, you know, uh, self-design models or direct business or whatever. But why don't you go ahead and just give an introduction to Axiom and what kind of value that can bring to clients?
Sure. So Axiom is essentially an asset management platform where advisors like yourself can open an account, and really you have access to many third-party money managers that oftentimes you don't really have access to any other way. So we have strategies on the platform from PIMCO, from American Funds, from Vanguard, and most of the big shops, down to some of the smaller names that maybe you're not familiar with, like SEM, which is a bond manager out of Phoenix, or Anderson Capital, which is an equity strategy out of Boston. And so what we really do is we help advisors sort of blend these strategies together. And that's really the value that I think that I add in working with advisors like yourself, Andrew, is, you know, we know we need 7% a year to meet our clients' goals. But
Mhm.
how do we get that 7% the most efficiently without taking on too much risk, or without taking on too little risk and not getting the 7%?
Mhm.
There is a science and there is an art to that. And part of what I do is to help advisors like yourself blend these strategies together so that we get the most efficient portfolio. We
Mhm.
get the exposures we need. We have the appropriate amount of risk so that the client experiences what they were expecting.
Hmm. Hmm. Yeah, and that's great because where I lean on you for some of this design, clients who have plenty of money and there's not really a question about how that if they're going to meet their financial goals and they've got long-term time horizons and they've been in the markets for a long time. I'm not nearly as worried about them as I am, someone who their retirement might not be quite as well funded. They might be more worried about economic drawdowns, stock market drawdowns, and so that's where I like to get a custom design for them, and be able to lean on your expertise and then the resources available through Axiom to just make sure that hey, we're putting their money to work in the most you know in the best way from a risk and reward standpoint. Anyway, thanks
Yeah,
for that
yeah,
introduction.
absolutely. Yes, of course.
So, like I said, I put some topics for our conversation together, and I'd love to, get your take on them. Those those topics are, just the opportunities as well as the risks in the current market, where we stand on inflation and interest rates, what investing during an election year looks like, and where my clients are really going to be interested in is what trade-offs or what adjustments would make sense to make in the current market environment. Um, so, putting these slides together, thinking about opportunities, it seems like AI has really defined the narrative for, the last few months. And we're in the middle of a pretty strong bull market rally, or maybe closer to the end of it. I'm not quite sure, but it's definitely been driven by a lot of excitement around AI. What do you, I believe it's going to transform the economy and it's going to result in a lot more potential profitability for companies that can adopt it, efficiently. What's your take on that?
Yeah, I mean, I completely agree. I think the thing that's most similar to it that we've seen in the past is obviously the internet revolution and how that really changed the world and changed business. There wasn't an area of our lives that it hasn't influenced.
Hmm.
Um, I do think that it's a little bit early right now to really say for sure exactly in what ways this is going to transform the economy.
Hmm.
I mean, just recently, if you looked at Google's earnings and you read any of the transcript from what the CEO was saying and some of the analyst questions, um, the analysts are starting to get a lot more poignant with their questions about all the spending that Google is doing on AI and where is it going, and what's the ROI for this? What's the return on the investment
Hmm.
for this spending that they're doing? And they can't really give too many specifics on what it's going to do or how
Hmm.
it's going to make them more money. Really the only thing that you can point to, or the only thing that I've heard them say is maybe their algorithms are going to get better at predicting what you might want to see. But that's really about it. What I think this is mostly about is going to be just data processing. And now that we're going to be able to process data more quickly, that does open up a lot of different doors for us. But I don't think that AI is quite at the point that the market really thinks it is, where, we're all going to be replaced tomorrow by machines, and, AI is going to just start, instead of going to a doctor, we're going to go talk to a computer instead. I don't think we're even close to that. I think that, and that's where I think the market maybe is a little bit ahead of itself. But I
Hmm.
do agree that at some point, I'd say probably within the next 5 years or so, we will get to a point where these machines can make decisions. And that will start to have an impact on the economy. And I think that it really will be like the internet was, 20 something years ago, 25 years ago, where there's not an industry that wasn't affected. And I think that's really going to be the next thing that drives earnings higher, really over the next decade and maybe even 20 years plus.
Hmm. Just just the scale in which companies are able to achieve profits and the efficiency in which they're able to achieve profits by adopting, the technology in a well-managed, efficient way is what you're saying.
Yeah, exactly. I mean, look at like a company like FedEx, for example, this logistics firm,
Mhm.
right? I mean, if they can harness the power of AI and they can compute better routes for packages, more efficient
Mhm.
routes, more timely routes, they can accommodate delays or road closures or weather patterns, right? They're gonna be able to charge more for their packages. Delays are gonna be fewer in number. I mean, that's just obviously one example. Again, in the year 2000, we had no idea how the internet was going to change the world. And I think
Mhm.
the same is true here. We can speculate and come up with ideas, but it's really I really think we just don't know exactly how it's going to happen yet.
So
Um,
because we don't know exactly how it's going to happen, it's clearly then answering my next bullet point, which is not too late to benefit. Like we're still in the very early stages of
yes.
this type of cycle that can drive companies higher. Because at the moment now, it seems like there's a handful of companies that are bringing this type of software to market, and those companies are there's a lot of excitement around them. You mentioned Google. Everybody's heard of NVIDIA at this point because of its performance, and some of the other companies that we have kind of been called the Mag Seven. Um, but where the real market large adoption and spreading out is going to be when it's not just the software developers, but also regular kind of classical companies. You mentioned FedEx being able to adopt this into making their businesses more efficient.
Yeah, absolutely. It's not at all too late to benefit. I think this is the first inning, really. I mean, this is, this like it's so early that again, I keep going back to the internet bubble of the of 2000s, right, where we didn't really know exactly how it was going to play out, and we couldn't
Mhm.
really predict all the ways in which it would change the world.
Mhm.
Again, I think there's something similar here.
Mhm. Well, that's a
What we're
good.
seeing,
I'm sorry. Go ahead.
yeah. Oh, well, I was going to say what we're seeing now with with the Mag 7 is, these are the companies that are going to be the first, obviously the first to benefit and the
Hmm.
first to really roll out and to harness the power of AI. They're the ones making the big investment,
Hmm.
right? Every dollar Google spends or Meta spends on AI, I would say about 80% of it, 80 cents of that probably goes to Nvidia,
Hmm.
right? And so
Hmm.
that's why we've seen Nvidia shares skyrocket, because all these companies are in an arms race to get the fastest processors, to have the most data capacity. And there's really one chip out there that is better than the rest, and that's Nvidia. And
Okay.
so anyway, I don't want to get too much. You mentioned that maybe that was a good segue into something. I don't want to
Yeah,
get
that
us
I
off
mean,
track.
well, that's a good segue too, because you mentioned a couple times how we're in the early innings of AI, and it kind of brings up what a lot of my clients remember in the early 2000s as what's now known as the tech bubble. Um,
Hmm.
but how are things similar and how are things different in your perspective compared to where they were, at that time? Obviously, it's the similar because there's just so much tremendous concentration in the top names of the stock market.
Hmm.
And they're so much disproportionately more valuable than the rest of the companies, even in the S&P 500, which are huge, large cap companies. So obviously that's the similarity, and the valuations are starting to really, go higher and higher. But how might it be different? I don't think what you're telling me is that, um, it's exactly the same. It just feels the same.
Right, exactly. And I'm glad you made that point. I don't want to liken it to the tech bubble because that's exactly what that was, right?
Mhm.
It was a bubble. What's different about this, I think to your point, what's similar to me, what's similar about now in 2000 is is culturally, um, we're about to have a level up experience, right? Where the internet sort of changed everything. It changed the way we communicate, as we all know. And I think that AI will have the same effect, on business, on our personal lives, really on the world. And so
Mhm.
in that way, it's similar. But what's different about this tech rally that we've seen is it actually is backed by earnings. It's not all speculation. You know, Even though Nvidia stock price has gone up gangbusters, it also has the earnings to back it up.
Mhm.
Um, and so if you look at how these Magnificent Seven, except for Tesla, that's kind of the one that is pretty overvalued. But the others are not that overvalued. In the tech bubble in the 2000s, the top names, the top 10 names, had a valuation that was more than twice what the average was for the rest of the market.
Mhm.
Now it's only a 30% premium to the rest of the market. So even though these names are 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 performing well, and that's led obviously to really good equity returns, they also have the earnings to back that up. And
Mhm.
so that's really the difference here is that it's not a bubble. Yes, they're trading at a higher premium than the rest of the market. And I think you can make a case as to why that should be so. But it's not so much where, there's not so much exuberance in these names, again, save for Tesla, where there's no earnings to back this up. That
Mhm.
is not at all what we're seeing. And so that's why I think that that's what makes this so much different now. And that's what really makes this not a bubble as it was in 2000.
Yeah, I wasn't in the business then, but certainly done reading and listened to people who have. There was a realization in the early 2000s that these companies, even if they outperform their earnings expectations for years to come, it still couldn't justify the current valuations, and that is where the danger is, and what my clients typically get worried about is, are we in a market that's too top heavy, too overbought? And I always remind them, it's really hard because it's yet to be seen. If earnings continue to back up valuations, then the market will continue to keep a positive momentum in the direction that we like. If they swing and miss, which we saw Google swing and miss this week, and Tesla, and that might lead to a bit of a rotation, or even maybe a bigger correction. But so far so good. It seems to me, and it seems like that's what you're reiterating as well.
Yeah, I think what's really happened so far this year is the market is kind of, as we know, the market by nature is a forward-looking
Hmm.
entity, right? And so what it's really done is it's looked ahead for these Mag 7, for these big names like Google and Nvidia, and it's essentially pulled those earnings forward in the sense that that's why we've seen this rally is it's looking ahead, it's saying, okay, these companies are going to be making a lot of money, so
Hmm.
that's why the stock prices are rising. And so now it's kind of now it's time to kind of, the chickens have come home to roost, so to speak. And it's like, okay, well, you've been making these investments in AI. We've been expecting big time growth. And so far they've delivered. And now the expectations are fully baked. And
Hmm.
so I don't think there's a correction coming per se. I just think that, if anything, I would expect there to be, kind of market moves sideways as long as these companies keep meeting the expectations that are already pretty high. The market should again, that's what the market's expecting. So I wouldn't expect too much of a sell off.
Sure.
Should we see that?
And just because the S&P 500 or the Nasdaq moves sideways for a little while, that doesn't necessarily mean there's nothing else to buy. And maybe you want to speak on that in terms of opportunities, because I read recently that, when you strip out the Mag 7, the rest of the S&P 500 is actually trading at a really reasonable level,
Yeah,
historically
yeah,
speaking. And one that might
yeah,
almost bode like, hey, we've got some real positive days ahead of us potentially.
yeah. I think that is true. Certainly, when you strip out the Mag 7, the rest of the 493 are trading at a much lower uh, multiple, usually around 18 times earnings.
Mhm.
Um, whereas the Mag 7, I think, their average is around 25.
Mhm.
With that being said, though, growth has been I mean, it's been good, it's been positive. Um, but a lot of that has basically come on the backs of price increases. There hasn't been a whole lot of like
Mhm.
volume growth in a lot of the rest of the 497. Really, where we've seen the most growth is in those Mag 7. And that's why the stock prices have done what they've done. The other 493 are growing just at a much slower clip, kind of more around the 3 to 7% range. It kind of depends
Mhm.
on which sector you're talking about. Um, However, we did get a really solid GDP print earlier this week, and that I think surprised everybody to the upside. Expectations were for GDP to have grown 2.1%, and it came in
Mhm.
at 2.8%, which is
Mhm.
awesome.
Mhm.
Um,
And
and
that's
so
a good
that's really
point.
that.
That's a good point too, because I've heard in the past, and I think it's a good metric, that when GDP is underperforming, the market's going to give disproportionate weight to the companies that are growing, where there is growth
Yes,
opportunities, and that explains where it might be a little bit more narrow. And but when GDP, is better than expected, you could very reasonably see a broadening out, kind of the same mentality that a rising tide lifts all ships, and so to speak. Um,
yeah, exactly right. And that's really what we've seen take place over the last week or so in the markets is as inflation has come down. We got another good inflation report today, um, where it's looking like the Fed is going to start cutting probably in September. The market now has about almost 100% likelihood of that happening,
mhm.
um, and that really bodes well for companies that aren't growing as fast.
Mhm.
Because as rates come down, it makes their borrowing costs a little bit less. Consumers feel a little bit more inclined to purchase things if rates are a little bit lower. And so we've really seen this shift from growth and into more of the value names. And obviously, a week doesn't make a
Mhm.
trend, but it really would be nice to see some of the other 493 names start to catch up
Yeah,
in earnings for sure.
and not to mention the 2000 names in the Russell 2000,
Yeah,
which
that's a
which is
whole other
really,
story. Yeah,
yeah, which has
yeah,
really been hard for a long time to explain to clients why it's important to own, things outside of the S&P 500.
hmm
Which, I don't want to get into small caps and emerging markets and things like that. I want to stay high level. And so moving on and just keeping things high level. Um, we talk about opportunities, and I think it's kind of a so far so good, as long as earnings are holding up, which they are, and positive GDP, positive inflation prints. That's all good stuff. And so I would encourage clients to be that, maintain their, I always say, cautiously optimistic, until proven guilty. Um, anyway, but let's talk a little bit about what risks are in the market. Obviously, we had a pretty ugly spiel, a pretty ugly inflation cycle, and we're coming down from that, and things are looking much better. Um, but it's not good when people hear inflation was the worst it's ever been in 40 years. But I've also believed, like, this is not our father's inflation of the 1970s. The economy is tremendously different. But that still means that inflation is a problem. Where do you see things are from an inflation standpoint? What's the good news, and what else might create issues in your opinion, uh, and where we are just on the inflation topic?
Yeah, well, I think inflation has largely been wrangled by the Fed. I mean, the inflation print that we just got puts it at about 2.5% year over year, which is just slightly above their target. But they have indicated that they'd be willing to kind of move on that target to be more between 2 and 3%, which I think is more realistic.
Mhm.
But really, what happened with COVID was something that none of us have ever seen before.
Sure.
When the economy shut down, and then which I think was the right move by Congress, was to act and to basically give everybody cash, simply because we didn't really know what we were up against. We didn't know how dangerous the virus was. We didn't know how long this would go on for. And that obviously, that has, you combine that with the supply and demand shocks that we saw as a result. Obviously, demand went to zero for services, but it
Mhm.
went through the roof for goods. And then in 2021, it flip flopped and everything reopened. And now no one wanted any goods. Everybody wanted services. So then services inflation went nuts. And so, you know, we're just kind of at the point now where the pig is through the python, so to
Mhm.
speak. It's just now kind of getting to the end of that, where the supply chain kinks have been worked out, the demand kinks have been worked out. But it's been a rough ride getting here, and there
Mhm.
is still a little bit more to go on that. But I think overall, I think the Fed has done a good job. Um, there was really no, to your point, there was really no inflation prior to 2020,
Mhm.
and I think in large part because of all the technological advances that we
Mhm.
had,
Mhm.
just kept things low. And I think you're going to see something similar with AI. I think that's going to make things a lot more efficient and keep prices down, and that should be disinflationary.
Mhm.
Um, but I think that inflation is and certainly the market. I hesitate to say that I think inflation is that you can stick a fork in it and it's done, because you never want to say that, of course. But certainly the market is looking ahead, and the market is feeling pretty comfortable with where
Mhm.
that's at.
Yeah, I
Um,
think I think the hardest thing to grasp, from with the fight against inflation, is that it's always, to use, you used the baseball analogy saying we're still in the first inning of AI. Well, we might be in like the eighth or ninth inning with inflation, but getting
yeah.
getting down to that Fed target, it's always the last like percentage point that's the stickiest. We can bring it down from 9 to 8, reasonably easy, and even from 8 to 7, and then 7 to 6, like that happens relatively fast. It's the bringing it down from 4 to 3 to 2 that takes disproportionately longer.
Yes. Yeah, it really does, and that's really what we've seen. Inflation's been sub four for, I want to say, 18 months.
Hmm. Hmm.
And we're still not at two yet.
Yeah.
But that's kind of the way it goes sometimes.
It,
And I think the supply chain kinks that we had, it's as much about people having too much money to spend as it is about the supply chain issues that
Mhm.
we had, with huge shocks to where
Mhm.
demand was at and what people wanted.
Mhm. And then just spending, in general, spending was tremendous, and the stimulus that was provided to the economy, as you said, don't think it was the wrong move. We have to, everybody's got the benefit of hindsight, and everybody can be a critic when their hindsight is 2020. I always
Hmm.
encourage my clients, you know give yourself a break for making the decisions that you had with the information you had at the time.
Hmm.
I think that that's important. But yeah, I do think, from a federal spending and a supply chain, it's been a longer fight than people really hoped for. But that leads us to, the other risks of the market. Because I talk in my financial planning meetings with clients, I talk about both inflation and recessions all the time. Take inflation with a grain of salt, because inflation doesn't happen without demand. And when we, and it's not as though you want to wish demand away, right? We always want to strike that equilibrium of healthy growth. But if we kill demand too quickly, then we slip into recessions. And I think that's what a lot of clients begin to worry about too. Inflation's been the hot topic, but talk to me a little bit just about recessions and what they do to portfolios, and why that also has to be on the radar as well.
Yeah, well, recessions are just sort of part of a normal, healthy market cycle. Um, it's an opportunity for the market, for companies to kind of cut back, to cut fat, to lean out, chance for consumers to prioritize their spending as well.
Hmm. Hmm.
Um, and we are starting to see some of that happen. We have started to see consumers start to slow down. I think maybe we got some fatigue out there. I also think that some of that pent up demand from COVID has been worked out.
Hmm.
And certainly among net borrowers, they're starting to feel the interest rate increase as well. Low income earners are starting to feel squeezed as well. So they're spending, again, they're just reprioritizing. They're spending about the same. They're just not spending on discretionary items. They're
Sure.
spending more on staple goods, right? So, and that's really what that's kind of the first sort of crack that you'll see in the economy is, a change in consumer habits to needs instead of wants. And we've just started to see that pendulum swing a little bit. And that's why I think the Fed is about ready to cut, because it's starting to see, okay, inflation's under control. We are starting to see the consumers feeling the higher rates.
Hmm.
They're changing their habits. Demand is starting to moderate. We should probably cut. But obviously it's a balancing act, to your
Yeah.
point. You don't want to cut too soon because inflation comes back, and rears its ugly head again. And here we go again.
Hmm.
Um, and obviously you don't want to wait too long, because then you'll drive the economy into the ground. And so that's why I said I think the Fed's done a good job here. Even though I know critics say they were a little late to the game, I think that's okay,
Yeah.
because you got to wait for inflation to show up before you start hiking rates. Um,
Yeah. And
and
we
so
saw
even though
that.
they were a little bit late,
We
go
saw
ahead.
that in 2018 when they were eager to hike rates, and
Mm-hmm.
and the market started selling off immediately. Um,
Mm-hmm.
and then yeah, so we've seen that play out in the past. I agree. I think the history books are going to be kind to this Fed. Um, I think it's important to remember that psychologically, when markets are down, days feel like years. And so that's why it's felt so long. But when we look back on it with the benefit of hindsight, we're going to see that, it was a very aggressive, rate hiking cycle. But the actual calendar period in which the market was down as a result of that has done pretty well, and the economy has held up, which kind of, the proof is in the pudding, so to speak, there, that if the economy held up, then that means the Fed didn't go too crazy with raising rates. They achieved their goal. Anyway, I always like to contrast this inflation to recession in my planning meetings with clients, because they're both risks, right? And as you mentioned, recessions are part of the natural cycle. They're not something to be feared. I often will say, just because you might twist an ankle or pull a muscle doesn't mean you shouldn't work out. Working out is still very, very healthy for you, very, very good for you. And I think that, the risking recessions and losing money temporarily in your portfolios, it's still worth it, because to combat inflation, we have to buy assets, and we have to buy, assets that are going to participate in that inflationary environment. Otherwise, inflation is going to erode your cash and your bonds. And you will not be better off for having been too conservative, in the grand scheme of things. And so that
Yeah.
that that tug of war, I always try to emphasize. So I appreciate your thoughts on that.
Yeah.
One thing about about that I've been following for a little while as far as opportunities and risks is just this pending wealth transfer that people like to talk about. The baby boomers are the wealthiest generation to have ever exist, and they're getting older. And then my generation, the millennials, are very, and your generation as well, Paul, is very populated. And there's a lot of complaints that we might not be as well off as our parents were at the same age, but the millennials are growing, and they're heading into their peak income years. And so that's going to create both opportunities and risk for the market over the next 10 to 15 years or so. What kind of thoughts do you have on the idea of boomer habits versus millennial habits, and this wealth transfer that's going to start to materialize here?
Yeah, well, I think this might be an area where you're probably more well versed than I am. But certainly the thing that comes to my mind is the housing shortage that we
Yeah.
have. You know, um, in a portfolio I manage, we have an allocation to some home builders in there just for that very reason. We just need more homes.
Hmm.
Um, and whether or not, I think a decent amount of the glut that we see in the housing market is the lack of supply really comes down to, I think a lot of it comes down to investment properties. You
Hmm.
know, I don't know. I need to kind of look further into this, but to me, with so many people that own these investment properties, that obviously takes supply out of the market. And so when you have a homeowner that owns 3 or 4 homes, that's going to eat up that supply. And so that's why we see housing prices continue to climb, not just because there's a lot of people that are sort of golden handcuffed in with a low rate and don't want to sell into a high rate environment, which obviously makes sense. But I
Hmm.
think a lot of the supply is just because a lot of folks own multiple homes and maybe rent some out as investment properties, or they just, have multiple homes.
Hmm.
But
Well, not
regardless
to
of
not to
that, I
mention
think,
the individuals, but also the institutions that are
oh
buying
my goodness,
single family homes, and yeah, it's pretty
oh
hard
my,
to pretty
so
hard
true.
to outbid billion-dollar hedge funds and things.
Yeah,
You
a
know,
private equity firm,
correct.
totally true. And I know KKR is into that too. And I don't know if that's something that Congress needs to get involved in. I mean, I don't, politics aren't really my thing, but it certainly seems like that's displacing a lot of people and, uh, you know, causing this sort of crunch that we see in housing prices. But, um, so to me, again, this might be an area where you're more well versed than I am, but to me, housing seems like the biggest issue here for millennials.
Yeah, I think housing is going to be kind of a sign of, almost a sign of luxury, as sad as that is. When you are someone who has, like, housing is going to become something that gets passed down across generations. I'm already starting to see that just in my planning discussions, where you've got families who want to have major conversations about, hey, like, how can I sell my home to my son or daughter and their family, via like a private mortgage or something like that, at a rate that they can
Hmm.
afford. Things like that. There's going to be a lot less, also, like, selling of homes, as inheritances. Like, let's say, couple passes away and they had 3 children, they left their family home to the 3 children. 3 children sell it and split the money 3 ways. There's going to be a lot less of that, because likelihood that one of those 3 children is going to want to buy the house,
Right,
because
right.
of the shortage. So there's a lot of planning opportunities around real estate, specifically because it's become, because inventory has dried up so much for all the variety of reasons. Um, but I think, sticking to just the stock market and how people are invested, I think that this actual wealth transfer presents a pretty strong opportunity, mainly because as millennials continue to get older, they're more versed in investing than their parents were, by and large. They just have access to the information easier. You can open up an app and trade basically for free, which was a luxury that, like, their parents really didn't have at the same age. And the elimination of pensions, um, and the introduction of 401ks and then the introduction of index funds and things like that. Millennials are very, very aware of these by and large. Now, don't get me wrong, every generation has its winners and its losers. Every generation has the people that make smart financial decisions and people who make poor financial decisions. So I'm not saying millennials are immune to that. But what I am saying is that millennials have access to the market, even if they don't mean to, even if they're forced to, just because that's what their employer retirement plan is, at a much higher degree than any generation before them. So I'm optimistic in that sense that there's going to be just more purchasing of shares, on an ongoing basis moving forward than there was in the past, when people had to select individual stocks and call a broker and pay a sales charge and things like that. It's just become a
Yeah.
lot more streamlined, and I think that this is what we were talking about earlier, just an adoption of that technology and makes markets more efficient and also presses them in a positive momentum direction.
No, I think you're absolutely right. And I think, you're talking about kind of the positives of this. And, I think, to kind of back your point, one of the negative side effects that we've seen is this meme stock phenomenon that we've never seen before. And
Yeah.
I think that's a negative consequence of what you just mentioned, right? How easy it is for people to access markets now. I think you make
Mhm.
a really good point.
Yeah, I mean, and that's why there's just so much more volume than there used to be. I think research came out, and I'd have to get this up before I'm willing to quote it. But people used to buy shares of one or two stocks a year, and that was really it.
Hmm.
And now it's basically unlimited. So that creates definitely price efficiency, but it also then sometimes creates things that aren't actually healthy or good for anyone, such as like the meme stock craze we saw, following COVID. But I think I
Yeah.
think
Yeah.
overall, I think overall, just because of the way retirement plans are structured and the way that our capital system is structured and the absence of, you know, um, like that much retirement entitlements among our citizens, and then the earning power. I think all of that, kind of people need to remember that the scales are kind of tilted in our favor for those who can participate, in financial markets.
Yeah. Yeah. Absolutely.
Anyway, we talked about all this, inflation and interest rates. We went through a lot of it. How why it's harder to get through than people sometimes realize. Um, and why the higher rates, definitely have a tougher impact on new borrowers and smaller stocks. Um, but why we went over a lot of these points, so I'm not going to make people listen to it again. Let's go ahead and get into, the election. Um, I've always said, people always ask me how should we reposition with the coming election, and I always try to remember and remind people, look, the stock market has gone up under Democratic presidents as well as Republican presidents, and the stock market has crashed under Democratic presidents as well as Republican presidents. And I'm like you, I try to stay as apolitical as I possibly can and just focus on the facts. But I would encourage people to just say that we are in a situation that really hasn't been seen before, where a president decided not to run for reelection. One of my bullet points was expect Democrats to present door number three. The reason that this is on there is because I had to get this I had to get this presentation approved in advance, and we didn't have the latest news yet. But I just encourage clients to always remember that the only reason politics has a true impact on your portfolios is because markets don't like uncertainty. And the more uncertainty there is, the more gun shy the markets are going to become. But it's always short lived. There's always another thing hitting the news that has a positive or negative spin on it. It's very, very hard to make decisions. I strongly discourage people from making long-term decisions based on short-term news. And so
Yeah.
just
Couldn't
wanted to
couldn't
touch,
couldn't agree more.
yeah, get
Yeah.
your take on that.
Yeah, couldn't agree more. What we do typically see in election years is the months leading up to it. There is a little bit more volatility. To your point, you'll kind of start to see, and we have, kind of started to see some of the sectors that are sort of uh, pro Trump or anti Trump, as far as his economic policies are concerned. You can kind of see those reflected in the market. So some of the chip stocks sold off as
Mhm.
he's kind of mentioned that maybe he wouldn't back Taiwan if China invaded, and so that's obviously not good for chip stocks. Um, we've seen some solar companies get hit as some of those subsidies may go away. So but again, to your point, those are all pretty short lived, and it's kind of the market just sort of jostling, if you will. It's kind of the market just sort of readjusting its expectations on where the future earnings may be for these companies because of these potential economic policies of each president. But in any case, it is short lived. And to your point, markets go up, doesn't matter who's president. And it's not something that you should be overly concerned about.
Mhm. It's very refreshing to know that, we're under no obligation to make the correct call by the time the election happens. Instead, we do have the benefit of being able to wait and just see what happens, and then continue to wait and continue to wait and continue to hold and continue to hold. And if you're willing to stick to that strategy, it's never not worked out. So.
Yeah. Yeah.
Anyway, I think what most of my clients would be most interested, just to get really pointed, with our last few minutes, is, what trade-offs should I be making when they give me their time to, drive to the office, or log on to Zoom, or take a phone call. What they really want to know is what should we be doing? What adjustments should we be making? And so I've always said, the best adjustment is to just know what you own and why you own it, and stay disciplined and true to who you are as an investor. If you believe in passive participation in markets, do that. If you believe in a more active approach and want to find the best opportunities, make sure you're choosing a manager that will do that for you. Because back to what I said, the holding period is the greatest determination of success in the markets. Um, and everything tends to have its day in the sun. Markets do rotate. Leadership does change over. So staying disciplined and true to who you are, and always make a decision based on what your financial plan needs. So if you're in a position that, like I mentioned, you're overfunded on your financial goals, make your investment decisions based on that, not necessarily what you think the next quarter is going to look like. But let's just talk about, from a technical standpoint, and to get, details. Growth has dramatically outperformed value for a little while now. Large cap has dramatically outperformed small caps. There's a lot of money in money markets and CDs versus bonds. Annuities are starting to become, or have been for quite some time, much, more interesting than they were. So what kind of adjustments and trade-offs are in the portfolios that you're managing, are you thinking about here over the next few months as we wrap up 2024?
Yeah, it's a good question. There are some changing dynamics, and I would kind of echo your point earlier about that you don't want to get overly tactical. I mean, the whole point of portfolio construction is to build something that performs well in any type of market. And so kind of timing the market and trying to figure out where to go next, and where, what's the next boom going to be, or where's the next bust going to be, that's tough to do.
Hmm.
However, I will say that sometimes, you do need to make some adjustments. And one of those things I think is money markets. Right now with the shape of the yield curve, which is inverted, right? And that means that short-term rates are higher than long-term rates. So, the 60-day interest rate to borrow money is higher than the 2-year rate to borrow money. And that's because that's what the Fed controls. The Fed controls that short-term interest rate. And right now that's at about 5.5%.
Hmm.
Well, if that's expected, and that's what money markets pay, right? Because money market is very short-term, less than a month type maturity on super short-term debt.
Hmm.
Um, and so a lot of clients moved to money markets when they started to hike rates, as they should have, because again, with the shape of the yield curve, you're getting more in interest to go short term than you are to go long term. Well, that is about to change. And
Hmm.
so you mentioned a lot of clients in money markets, and I get a lot of questions about this too. And I think that one thing that you can do is kind of go a little further out on that interest rate
Hmm.
curve and take a little bit more uh, duration or interest rate exposure and kind of go further out. And what I mean by that is, buy a 3-year bond or 4-year bond and really lock in that rate, because as soon as the Fed cuts rates, which is likely to happen in September,
Hmm.
your money market that pays 5.5 won't. It'll
Yeah.
pay 5, or it'll pay 4.75, or whatever they lower that to. And so that changes the shape of the curve. And so if you can go out a couple years on the interest rate curve and buy a bond or a bond fund that has a duration of about 3 to 5, you can
Mhm.
lock in, a 5% yield for 3 or 5 years,
Yeah.
right? Whereas if you're sitting in money markets, you're kind of at the whim of what the Fed wants to do. So that's one thing that I would urge clients to take a look at, is how much cash do I have? And while you've been generously compensated, in my view, 5.5% to hold cash is great,
Yeah.
and I
Yeah.
think that's been a great move. But it won't always be like that, and it looks like that's going to change soon. So that would really be the one area where I would kind of take a look at.
Sure. Sure. Um,
Um, you mentioned the growth versus value as well. That's been an ongoing sort of theme even before COVID. Growth is, to me, I'm a growth guy. I prefer growth stocks. Value stocks have, like you said, they have their day in the sun. They're
mhm.
having that now, as they perform better in lower rate environments. But to me, I've always preferred growth. So I'm always kind of gonna gonna urge people to kind of go more on the growth side of things.
Mhm. Mhm.
Um, more than value. But what about you? What are your thoughts?
I mean, I think that I echo the same things. I think just being true to who you are, if you're a moderate investor, be a moderate investor. If you're a passive equity kind of person, do that, because ultimately it's your holding period. And I always remind clients, just like remembering that time in the market is going to beat timing the market. And there's tremendous risk to missing out on the really good days. And people have to remember that. And this was a great chart, that came up with what were the best days in the market of the last 20, basically since the financial crisis. And they always came at the worst times when people were most spooked. And it's
Yeah.
important to remember that, if you miss those days, then you might as well be in money market or bonds. And I encourage people to do that. Like if don't tell me that you want to participate in the market if you then want to move to cash when things get tough, because like that doesn't pay off. And all that does is create, short-term pain that's unnecessary. And especially in the rate, where we are now with interest rates, if you want to be a conservative investor and just accept your 4 to 5%, and you're saving enough money to kind of stay ahead of the the inflation, because you're not going to get that equity premium, but you save enough, then that's totally fine. Just be honest with who you are, and build a portfolio that's built to last. My thoughts are that when growth outperforms value, or when value outperforms growth, like, that's what portfolio rebalancing is for, and why it's necessary. So that you can start to take in those gains. That's why I appreciate, managed portfolios so much, because I don't necessarily need to take big calls with the market, or abandon strategies that have worked just because they've worked. Like that doesn't make sense either. Don't cut your flower, or don't cut your flowers to water your weeds, and so to speak. But you know,
Yeah.
yeah, make sure you stay diversified. Make sure you stay true to who you are. Take the time to build a portfolio that you feel comfortable with and can live with, because then let time do the work for you. And that's the benefit and the beauty of being in financial markets is that you're not the one that needs to build and flip the house. You're not the one that needs to go door to door selling. There's an army of capital that's out there doing that for you. And you get to, instead spend your time doing things that you enjoy. Nobody really enjoys losing money, but it's always short lived. And that's important to remember. Um,
Absolutely.
so yeah, I would just say it's normal rebalancing. That's what I encourage my clients to do. Especially, and there's nothing wrong with moving from like 60% equities to 50% equities if we've had a pretty strong run. But please just avoid making the big dramatic moves, because then it's not, if you're right, that works out. But if you're not right, then you have to be right again as to what adjustments to make thereafter. And I tell a lot of my clients it's a lot easier to be tough than it is to be smart. So I'd rather be patient and disciplined than just hold tight and avoid making big dramatic changes to a strategy that has probably worked out well for you if you were invested correctly. Anyway, Paul, thanks so much for being on here. I wanted to give some clients the opportunity to ask a couple of questions. And, I think in about 5 minutes, we'll have been on here talking for an hour. And so if anybody has any Q&A, feel free to drop them, and I'll be happy to voice the question to Paul. But if not, thank you all so much for listening. And Paul, thank you for chatting with me. I really, really do appreciate it. And as always, I appreciate your insights and the value and the support that Geneos and you and your colleagues at Geneos provide.
Absolutely. It's my pleasure, Andrew, and I always enjoy our conversation. So really, my pleasure to be here.
Well, thanks so much. That's very kind. All right.